Hello all. Welcome to video 2 of chapter 21. We talked about general concept of sales tax and the two ways you can apply a multi-transactional VAT, whether it's account-based or invoice credit-based. In this video, we're going to talk about liability for HST, and we're going to sort of talk about what things do we apply sales tax to. So share screen. So liability for GST, the basic charging provision, every recipient of a taxable supply made in Canada shall pay to Her Majesty in right of Canada tax in respect of the supply calculated at the rate of 5% on the value of the consideration for the supply. So the supply is sort of the legal term for a good and service that was provided to you, the customer. So the government will collect 5% of the value, pretty much the dollar value of the item you've purchased, whether that was a product or a service provided. The legislation imposes tax on the recipient of the taxable supply, so whoever receives the product sold. The provider of the taxable supply, this being the business you're dealing with, will collect the sales tax from you and remit it to the government. So the business who collects sales tax, they don't get to keep the sales tax. They're really just holding on to it. And every month or every quarter, depending on their size, they will remit it to the government sort of on, I say on your behalf, but it's not like they keep an account for you when it comes to sales tax. So they collect it from you and then they provide it to the government. So the businesses fill that administrative role of actually collecting the taxes. Supply means the provision of property or a service in any manner, including sale, transfer, barter, exchange, license, rental, lease, gift, or disposition. So really, they're just trying to pick up all the words a business might use for a transaction. But generally, when you buy a property or a service from a business, you will pay sales tax on it. So the general rules say a supply made in the course of commercial activity. This includes supplies that are fully taxable at 5%. So 5% is the federal rate for sales tax. If the province uses a harmonized sales tax rate, there'll be 13% for Ontario, 15% for the other provinces on the East Coast. So if something's fully taxable, you apply the full sales tax rate. But we also have zero rated products and services. Items that are zero rated are things we don't charge sales tax on. So things like groceries. If you have prepared groceries, prepared hot meals, they will apply sales tax to that. But if you're just buying ingredients and raw supplies, there's no sales tax on those items, on those grocery items. But they can't just say no sales tax, because if they did that, the business would not be able to claim the ITCs. ITCs are sort of sales tax spent, the purchases, the cost associated with the item sold, sales tax collected. So by zero rating these products, they do charge sales tax. They charge sales tax at 0%. Since the sales tax is being charged, those businesses, like grocery stores, are allowed to claim ITCs on their HST returns. So some items are fully taxable, say a laptop or a new jacket, but items that are zero rated, such as groceries, do apply. Some HST provinces offer point of sale rebates for provincial portion of HST on some items. These issues are beyond the scope of the book, so we're not going to go into those. We're not going to go into those items that refund the provincial portion. So something might be charging 13%, but then you get back the provincial portion, so it's only charging the 5%. We're not going to throw those tricky product types at you. We'll pretty much just apply the fully taxable, those zero rated. There's also items that are exempt, but I think we don't get into those right away. So sales tax has to do with a commercial activity. So what does it mean when sales tax is applying to a commercial activity? Business carried on by a person An adventure or concern in the nature of trade, anything that makes a supply, excluding exempt supplies, by person of real property, selling or leasing real property. Exclusions to this are businesses or adventures in trade carried on by an individual, personal trust, partnership that has no reasonable expectation of profit, basically meaning it's not a source of income. So if I have no expectation of profit, then my activity is probably not considered business. It's more considered a personal endeavor. I don't have to charge sales tax for something I'm doing personally if I'm not doing it for income. So if I'm knitting sweaters for family and friends and they give me 20 bucks to cover the cost of yarn, I don't have to charge them sales tax because that $20 is not going to cover the cost. This isn't my profit motive. There are certain supplies that are exempt, so they don't charge the sales tax, but you also cannot claim ITCs. And employment services is they're not a business. So business includes profession, calling, or trade, or undertaking of any kind that's engaged in for profit. Any activity engaged in on a regular or continuous basis involves supply on property by way of lease, license, or similar arrangement. So what these tax rules are trying to do are trying to say, you are running a business, you're trying to make money, therefore this is a commercial activity, you should be charging sales tax. But there are organizations that partake in commercial activity that aren't businesses. A business requires a profit motive, but there are not-for-profits that carry on business not to make profit, but that's how they provide their services to the outside world. Perhaps they do things at a discount, or the business garners revenue to allow them to carry on their charitable action. But at the end of the day, they have no intention of that net income to be positive. Because the charity is not engaged for profit, it's not a business. But there's certain rules in the Tax Act to catch that perhaps even a charity should be charging sales tax. So we have supply categories. Since sales taxes are charged on supplies, fully taxable supplies, so items that charge that full 5, 13, or 15% tax rate, includes transportation in Canada, restaurant meals and beverages, clothing and footwear, concerts, sports events and other events, legal and accounting fees, furniture purchases, haircuts, cleaning services. The Income Tax Act provides a list of taxable supplies that are zero rated, which means although taxable, that tax rate is zero. So they are charging a sales tax, it's just equaling zero. This allows the provider to claim ITCs, includes a threshold amount for filing requirements. So basic groceries apply a zero rate. Prescription drugs and medical devices. Exports, so exports, if I produce a product in Canada and I sell it to someone in the States, even though it's produced in Canada and I should charge the sales tax, the tax is not on the American individual. So it becomes zero rated when I export it out of the country. Foreign travel and most agricultural and fishing products. No GST, no ITCs on certain exempt items. So basic healthcare, dental services by healthcare professionals, sales of used residential housing and residential rent. So when you pay rent on your apartment, you don't pay sales tax on the rent. It is an exempt supply. Land sales, if the land's not used in the business, and educational courses leading to certificates and diplomas. So education is also exempt as being a supply. You don't pay sales tax on it. So we apply our sales tax to tangible goods. The GST registrant calculates the sales tax based on the rate of the province where the goods are delivered. In this day and age where so much is purchased online, those items can be ordered from a company in Ontario, but let's say they're delivered to Alberta. Since that product is being delivered to Alberta, It's a tangible good, so we're going to use Alberta's provincial sales rates. So we'll charge the 5%, but we won't charge the provincial sales tax because Alberta doesn't have them. If the same company sells something to someone in Ontario, they will charge them the 13% HST. So sales tax for tangible goods, which rate we apply depends on where the customer who's receiving the goods is located. Real property, the rates are based on the province territory where the property is located. So tangible goods can move. We can put it in a box and we can ship it to elsewhere in Canada. Real property usually talks about physical property such as land, but land can't be moved. If you buy a property in Ontario, I can't pick up that lot of land and ship it to Alberta. Since it's locked here, the Ontario rates will apply for its purchase. Services, province where the service is used, province or territory in which person or location benefits from service. In the same way, the tangible good will be received in Alberta. The service is received in the point where that service is provided. So getting your hair cut is a service. So they will apply the tax rates in whichever province you are receiving the haircut. So if I live in Alberta and I travel to Ontario and while I'm here I get a haircut, that province is, we're going to apply the Ontario rates because that's where the service is located. So the basic approach, the rate is applied to consideration received in return for taxable supplies. So consideration usually is discussing the money received. So if something cost $100, the consideration is the $100 I give you. Monetary, the sales price or service fee, includes all non-refundable federal taxes, provincial territorial taxes, duties, and fees. So for example, $100 item is purchased in Manitoba by a Manitoba resident. So the GST that will apply is those rates that incur in Manitoba. So the GST is 5% and PST is 7%. So combined, you will pay 12%, $12 on this $100 purchased. If it's a non-monetary transaction, so let's say I need a laptop from you, but I don't have the $1,000 to pay for it, so I give a service to you in kind. This is called a barter transaction, where no money exchanged hands, only products and services. We have to figure out the fair market value of the service, or the fair market value of what was exchanged. So if that laptop's normally $1,000, I need to provide you the equivalent of $1,000 worth of services, right? So that's the monetary amount that will be based on the sales tax collected. So since that person got $1,000 worth of stuff, it's saying they collected $1,000, so they will also have to remit a sales tax portion of it. And that sales tax will be provided in dollars. So basic approach, effects of trade-ins. If I trade in, so let's say I'm buying a vehicle, so there's going to be sales tax on it, but I trade in a vehicle and I get a discount, the GST will be based on the net amount after trade-in. So it's almost like they'll charge sales tax on the full amount, but I charge them sales tax on my trade-in, so the net difference gets collected by them and remitted. So if Jeff Brown, a resident of Alberta, acquires a new car at a cost of $38,000, he trades his old car and receives an allowance of $17,000. So in the end of the day, he's paying a net amount of $21,000. The GST is 5% of that net portion, $21,000. So that equals $1,050. That's what he'll pay in sales tax. Collection remittance, the sales tax charges the tax to the recipient of the taxable supply. Collection is taken by the provider of the supply, so the business selling the product. They will collect it and remit it. Special regulations for store promotions offering no GST HST, fraction applied based on the GST HST rate. So what that means is some stores might have the promotion to say pay no sales tax. That sales tax still gets calculated based on what they're collecting, and the company still needs to remit that sales tax even though it wasn't collected. So when they're offering that discount to you, you may not be paying it, but they will still calculate a sales tax portion from the payments made and still need to remit it. Registration. We're just short of 15 minutes. I'm going to stop this video here and I'm going to start a new video to discuss the rules of registration.